If you thought a massive tax cut for imported goods would automatically make your portfolio more profitable, you might be looking at the wrong side of the balance sheet today. The Supreme Court eliminating emergency tariffs was the first move that mattered. Then we track how that missing tax revenue forced bond yields higher, bleeding straight into private credit markets. Finally, the part most people missed, we will look at how slowing consumer data piles up as inventory. Stay with me, and I will translate that into margins and cash. Let us start with the ruling itself. The U.S. Supreme Court struck down sweeping global tariffs, saying the administration overstepped its bounds. The common mistake here is thinking this is pure profit for companies. People see a 10% cost disappear and assume profit margins will expand forever. Retail stocks like Etsy jumped more than 8% on this exact thought. Think of it like getting a discount on your water bill, but your landlord immediately raises the rent to cover a leak in the roof. The savings do not stay in your pocket. Here is the earnings path. The government was collecting roughly $133 billion from these tariffs. With that money gone, the Treasury has to borrow more to fund the government. They issue more bonds. When the supply of bonds goes up, the price goes down and the yield goes up. Today, the 10-year Treasury yield climbed to 4.09%. For free cash flow, this is a zero-sum game. A company might save money on importing goods, but their cost to borrow money just went up. The cash they thought they saved gets eaten by higher interest payments. Your checkpoint for today is that lower supply costs only matter if your capital costs do not rise to wipe them out. Now let us follow those higher bond yields into the tech sector. This brings us to CoreWeave, an artificial intelligence infrastructure company. They just tried to borrow $4 billion from a private credit firm called Blue Owl Capital to build a data center. But because overall interest rates spiked, the lenders wanted higher returns. The deal fell apart, and CoreWeave stock dropped 8%. People often think the AI boom is only limited by how fast chips can be made. They think if the technology works, the money will flow. It is like having the blueprints and the tenant list for a massive skyscraper, but the bank refuses to give you the loan to buy the concrete. The building does not get built. Let us trace this earnings path. Data centers are incredibly capital-intensive. They need massive loans to pay for land, power, and chips up front. If private credit markets freeze up because bond yields are too high, the data centers get delayed. This hits free cash flow violently. If an infrastructure company cannot borrow, they cannot buy. This spreads directly to NVIDIA. NVIDIA is expected to announce record fourth-quarter revenue of over $39 billion soon. But if their customers cannot get loans to buy the chips, NVIDIA's future sales guidance has to come down. The takeaway here is that a tech company's growth is chained to the bond market's lending rates. Finally, while the credit markets were freezing, the real economy showed its own cracks. We learned that the U.S. economy grew by only 1.4% in the fourth quarter. The typical reaction is to blame the recent government shutdown and assume consumers will bounce right back. But consumer spending is like a giant cargo ship. Once you pull back the throttle, it takes a long time to get back to full speed, and everything behind it crashes into the bottleneck. Here is how this alters the earnings path. When economic growth slows, people stop buying extra goods. But retailers like Walmart already bought the products months ago. Walmart actually dropped 1% today after giving a weak profit forecast. When products sit in warehouses, they turn into inventory. This traps the company's free cash flow in physical boxes. To free up that cash, they have to run massive clearance sales. That slashes the selling price, destroying their profit margins entirely. Remember, a slowdown in the broader economy always shows up as dead inventory on a retailer's balance sheet. So, what should you watch tomorrow? First, track the 10-year Treasury yield to see if it stays above 4%. Second, watch for any commentary from NVIDIA about their customers slowing down purchases. Third, look at the inventory levels of any retail stock you own. Today, the market repriced risk because missing government revenue pushed borrowing costs higher, choking off funding for AI and squeezing retail margins. Find companies that can fund their own growth without needing expensive debt. This is not financial advice, just a translation of the market's mechanics. If this helped you understand the flow of money today, please subscribe and leave a like.